Hi, I'm Lee Stone, and this is your UFXBank Week in Review. Today we will cover some of the major financial events of the past week and discuss how they impact the global currency markets. But before we cover headlines of the week, let's look at last week's risers and fallers. The Euro-US dollar pair had a solid week, gaining about 1.7% and was last traded at 139.84. The British pound had a somewhat mixed performance this week against the dollar, making a rise of just under 1% and closing at 160.70. US dollar had a fair outing against the Japanese yen. The pair managed to finish the week trading at 82.30 for a gain of 0.8%. And once again, the US dollar slid against its Canadian counterpart. Overall, the pair dropped 0.7% and closed on Friday at 0.9716. Taking a look at commodities, gold had a near solid week of gains. By the close of Friday trading, the precious metal had moved up 1.4% and closed at just under $1,428 per ounce. Meanwhile, April crude orders had a strong performance this week, surging 2.85% on big gains from Tuesday, Wednesday, and Friday. The orders were last trading at $104.90 per barrel. In the news this week, the housing prices in the UK dropped more than estimates from last month, which spurred a rise in UK government bonds. This clearly indicates that the economic recovery is not sturdy enough to resist a hike in interest rates. During the last month, the Halifax House Price Index dropped by 0.9%, which was more than expert estimates. The pound had been fluctuating prior to fading against the dollar after the U.S. non-farm payrolls indicated a gain of 192,000 jobs. This is, of course, for the month of February, beating the forecast of 180,000. A revised estimate for January showed a gain of 63,000 jobs rather than the 36,000 initially reported. The jobless rate in the U.S. made a surprising drop as well to 8.9%, its lowest level since May 2008. Of the industry sectors that gained, the service industries rose at their quickest pace since 2005, while the manufacturing industries grew at their fastest pace in the past 7 years. In speaking to lawmakers during the week, Bernanke stated that the rise in equity prices, along with the tightening of corporate bonds, reflects a clear indication of the success in bond purchases. The S&P 500 rose 25% from August 27th, when Bernanke initially signaled that the Fed was prepared to launch QE2. The current economic data indicates that the world's largest economy is gaining strength. To discuss more on these hot topics of the last week, let's bring in analyst Martin Smith. Hello, Martin.
Hello, Lee.
So there was a lot of talk about Fed policy this week. Where do you think that it's heading?
Well, the Fed policymakers have signaled that they would favor a sudden end to $600 billion in Treasury purchases in June, thereby getting rid of their previous strategy of steadily pulling back on involvement in the bond markets. Dan Greenhouse, the chief economic strategist of Miller Tabak, said that if this is a self-sustaining recovery that can withstand higher interest rates, then why not get out? He did indicate, however, that he's still nervous about their ability to withdraw from these policies without broader disruptions. The Fed announced plans to buy $600 billion of Treasury back in November. The timetable was set for June and is in a bid to enhance the recovery. Also with the intention of diminishing the rate of unemployment, which has neared a 26-year high. The program for the second round of so-called quantitative easing has been designated as QE2 and would follow $1.7 trillion of asset purchases, which ended in March 2010.
Please share your opinion with us on China's recovery and growth.
Well, China's on track for yet another 5 years of healthy growth, but the only concern, in my opinion, is that inflation must be controlled. The top priority this year was to control the rise in prices that are hurting the average person in the world's second largest economy. There's a heavy demand in the market, and the supply of funds is also sufficient. But in addition, the general scientific and educational level of the populace is also rising. Wen Jiabao promised to enhance spending on education, public housing, and healthcare. The initiatives are intended to minimize the difference between the rich and poor in China, which has stimulated some bitterness. A heavy presence of police was noticed in the capital, and some rare public warnings against protests have highlighted the heightened sensitivity of the government. So it would seem that there are nervous parties who are concerned that the unrest roiling in the Middle East could possibly spread to China.
I think it's probably a long shot, but it'll be interesting to see how that one plays out. For our Ask the Broker question of the day, of the week, we have James Miller of Kowloon Island, Hong Kong, who writes, how valid is Gillard's concern regarding Australia's ties to a global commodity boom?
Well, we have all seen that Australia's Prime Minister, Julia Gillard, has highlighted the risks posed by the Australian economy's strong connection to the global commodity boom. I think that for the most part, this is a patchwork economy emerging from export gains accompanied by subdued domestic spending. Gillard has stated that she is very conscious that a strong Australian dollar has benefits and it has burdens too. Gillard's comments reflect a challenge faced by policymakers from Brazil to China, where strengthening exchange rates risks undermining exports unconnected to the climb in global commodity prices. While emerging markets have taken steps to stem currency gains, such as by putting limits on capital inflows, Australia has refrained from such measures, and Gillard said she favours letting the market set the price for the so-called Aussie.
Thank you very much, Martin. Well, that is all the time we have for today. We hope you enjoyed our weekly review, and we hope you will join us next week. Until next time, be sure to visit us at UFXBank.com for simple, safe, and secure trading. Also, you can follow us on Twitter and Facebook. To submit questions to our weekly broadcast, please email your questions to Martin Smith at askthebroker@UFXBank.com. For UFX Bank, I'm Lee Stone. Good luck and happy trading.